So first of all, first principles on these proposed capital requirements. What is the need for them? What is the problem that's being addressed here? Or is it really a matter of just complying with Basel III commitments?
Well, first of all, thank you very much for allowing me to join you this morning. This is, as Katie said, a very topical item today amongst both regulators and the banking industry. And, it's an attempt to kind of bring the Basel III to the end game, is what you've heard the regulators point to. And in July, they put out a proposed rule that would move a lot of the analysis to risk-weighted assets, and the impact of that by a lot of accounts, both the regulators and the private banking sectors, is that that would increase the capital level for those banks over $100 billion from 16 to 22%. And then the other large provision, David, to this is that it historically applied to banks over $700 billion, and now it will apply to banks over $100 billion. So a substantial increase in the number of banks that this will apply to.
Well, Joseph, let's talk about potential unintended consequences here, particularly when it comes to smaller borrowers. If we do see some banks pull back on lending for those smaller borrowers, as some have suggested might happen, what does that mean necessarily? Who steps in to fill that void, so to speak?
Oh, totally. Well, Katie, also just so the process is, the rule went out for comment. Those comment period ended on January 16. And then the regulators will go back and evaluate those comments that they receive from the industry and the industry groups and individuals. And then, it is hoped that they would incorporate those comments into the final rule. And so the rule actually today isn't completely baked. It'll probably have some modifications to it, but I think it'll be directionally correct to what, the regulators put out. And you bring up, I think, the most important point is by going to a risk-weighted asset methodology, there's probably has the risk of some serious reductions in credit that small businesses and consumers can access. And I think the unintended consequences really is twofold. One is the banks will see those over $100 billion, substantial increase in their operating expense associated with being compliant. And then the second thing that I think you're going to see is similar to what we saw in the housing sector, is we saw most residential lending leave the banking sector and go to non-banks. And I think we're substantially at risk of seeing, small business lending, perhaps higher risk consumer lending, and any business lending that would go to the private sector. And that's why you've seen, I think, the substantial increase of, companies accessing private capital. And it's one of the reasons why we're excited about Andalusian Capital is we want to be able to bring that to the middle market and be able to support that when people cannot find their debt levels in the banking industry.
Joseph, as you suggest, if it does drive more into private credit, it may benefit Andalusian and other private credit entities. Is there a downside risk to that, though? Having formerly been a regulator, are we pushing more and more of the financial system outside of regulation? Is there a risk for the overall system as a result of that?
Absolutely, David. I think we've always felt having it under the umbrella of the regulatory agencies, their really mission is to create a safe and sound banking industry. And that should be the goal. And the more you do push out, you somewhat lose oversight and control of that. And I think you can reflect back to the COVID period. I mean, historically, the banking industry, when there was a recession or economic challenges, the banking industry, like a lot of other people, would generally begin to compress down because of the need for capital. But through COVID, we saw a period where the banking industry was a source of strength for both consumer and businesses, and had the ability to continue to lend, to continue to have the ability to restructure credits. And that actually, I think, was a big positive in our nation's ability to recover from the COVID and allow our economy to continue to move forward.
Well, building on that, Joseph, if that's the case, we learned in COVID that at current levels of reserves, et cetera, that the banking sector was sound. What is the right level of reserves, so to speak? How should that even be measured?
Well, I do think this rule, by looking at risk-weighted assets, and what they mean by that is basically they would look at how risky is the lending, and that lending should require more capital against it. But Katie, it really gets down to, when is enough, both in capital and liquidity. And I think most people feel, both in the industry and the industry groups, that we're at that level today, and that this actually pushes, the industry further. That could have, as we discussed earlier, some pretty significant negative consequences. And I think the regulators heard that loud and strong when they went out with the comments. And now they'll take the 90-day to 6-month period to review those comments. And I think everybody's hopeful they'll come back with some modifications to that.
Joseph, we have to talk about regional banks. Since last March, there's been a lot of focus on regional banks and possible problems there, to some extent coming off of real estate issues. We have New York Community Bank. I know you can't comment on the specifics of that, but is that a one-off case, or is that indicating a larger weakness? I saw that in the KBW Regional Bank Index, it's really fallen off because of the news coming out of New York Community Bank.
Yeah, and David, I think if you look at the balance sheet of both the regional and community banks, historically their lending activities have comprised with a larger percentage of commercial real estate. And so just by the nature of the balance sheet having more dedication to commercial real estate, they're going to feel the impact, as we kind of start to see a reevaluation. And commercial real estate is really just a valuation of cash flow and then applying a value to it. And, there are, kind of 4 main components of that. What are the current cap rates? And those usually are, compare, what interest rates are. No one would want to, get a 3% coupon on a multifamily when you can get a 5% treasury. You would choose the 5% treasury unless you thought there was a lot of upside. And then the vacancy factors that commercial real estate is experiencing, where historically that was maybe 5%, we're seeing high single digits. And then we all know what's happened to real estate borrowing. People were borrowing at 3%, and today they're borrowing at 7 or 8%. And just as important, the operating expenses for commercial real estate has risen. People to come out and repair, to buy HVAC systems and things like that are up. So all of those are negatively impacting commercial real estate when those loans come up, and they need to be reevaluated for what the market is, and then the banks apply, a margin to that so they're within, acceptable lending standards.